I'm Greg Hunter. Welcome to USAWatchdog.com. With us a guest we've had on quite a few times, well, a number of times. He is an expert in silver. He's been studying silver since he was a young lad. He's not so young anymore, but he looks young. We're talking about David Morgan of silverinvestor.com. David Morgan, thank you for joining us today on USA Watchdog.
Oh, my pleasure, Greg, and you picked a pretty good day, too.
Well, I got to tell you, we're going to pick up where we left off the last time, a few months ago, and you said that silver at 18.17 and the intraday high would hold. That would be the low, and I've seen it down to below 18.17, my friend. What is going on in the silver market? It should be it is a scarce commodity. There's a lot of it being hoarded and being bought, and yet the price keeps going down. What is going on?
Well, a lot is going on, obviously, and of course, most people focus on the price action, which is very important and something I focus on myself. First of all, going back to the 1817 intraday low that happened over a year ago, I did say it would hold. I've said it several times. And recently, once we got into the $19 level and closed below the $19 level, I said that low is going to be tested. And actually today, as we're doing the interview, is the first day that it is being tested. Now, if we close above that level, that 1817 level, then, I'm still right, meaning that on a close-only basis, that it, did not close below the 1817 level. But it looks like it may. I don't want to make a big to-do about it. I did say it'd be tested. It is being tested. It certainly could go lower. I've also gone beyond that. And with my members, perhaps in the public domain, but members for sure, I told them that, it's possible if that 1817 does not hold, obviously, we'll be going lower. And we will probably see some type of spike low that would be similar to the 1817 low, which means that we would get a spike down, like maybe $1 or something like that, like from 18 to 17 or maybe even the 16s. And I think that would be a spike where it would be quite a dramatic drop, but there wouldn't be much contracts trading. It would be similar to what happened before, which means that there'd be some paper trading, and the paper trading that would take place in a very short time frame of time would drive the price higher. So it's primarily a paper-driven situation because it takes place at such a short duration. The ability for the silver investor, even if you're of size, like one of these ETFs, would not be able to call on the phone, get a primary dealer on the phone and say, hey, silver's at, $16.27 right now. I want to buy $500 million for it. That can't happen. It can only happen in the paper arena.
But why? Because the $500 million ain't out there. There's no physical cash for sale for $500 million is what I'm saying. There's not that many ounces to fill that order.
At that price, correct. You might get 3 ounces, but you're not going to get that kind of quantity at that price. That's correct. I just want to be very, very specific because a lot of people don't understand how markets move. And so there might be, 3 futures contracts, which is just paper, and maybe the person that bought it at that spike low instantly from their computer might be able to scan for delivery, but that would represent like, 15,000 ounces. But you're not going to buy 20 million ounces at that price. Can't happen. There is not that much available at that price. There's just a minuscule amount at that price. And really, in reality, there's just that price on paper. So that's what I want to emphasize because people that don't understand markets, go back and say, oh my goodness, look at it. It hit that price. I could have loaded up at that price. I could have bought the, no, that's not the way markets work. So hope I'm not getting overly complicated here, but it's very important to understand that, unfortunately, in today's casino-type environment where everything's run by derivatives and the underlying commodities or assets are really kind of second tier when they should be the primary focus in this helter-skelter world where everything's driven by computer algorithms and trading algorithms, we have a fictitious price discovery in a lot of these markets. Not to say that you can't buy silver at spot most of the time, but in those type of situations that I'm outlining right now and right here, because those events do take place and people tend to focus on them, the reality is, no, you cannot buy silver in size at those lows.
Well, what stops this casino mentality? Is this what we're stuck with forever? Because some people are just thinking, well, they're just manipulated forever, and therefore, why should I hold precious metals if I can't really get a true price discovery? What do you tell people like that?
Yeah, no, that's probably the number one question I get all the time. And, I've been consistent since I started silver-investor.com, and I said there would be a day where the physical presence, the real commodity, takes precedence over the paper traders. And we're getting closer to that every day, and people lose heart. They say, come on, these guys have got control. They're going to keep it going forever. They can't. But it's when you run out of physical silver. And I think, we've talked pre-show about the Shanghai Silver Exchange and how much has come off there recently. And I think that's a good discussion point because no one really knows where the point of inflection is. What we do know is that when there's a non-delivery of a fair amount of silver and it's publicly acknowledged, that's going to be a potential tipping point where all of a sudden a lot changes in the silver and or gold markets or both markets nearly the same time. And that's out there. It's going to happen. We just don't know exactly when. We don't know exactly where, but we know why. And when the why is the most important question. The why is that a piece of paper does not equal a physical ounce of silver. And there's a lot of fictitious silver out there still because relative to gold, it's bulky. Relative to any other commodity, it's really very small in volume. I mean, you take $1 million worth of silver and see how much volume it contains versus $1 million worth of wheat, for crying out loud. But relative to gold, it's bulky, yes.
Well, silver is unique in that people in China, that's why they have these exchanges, I'm sure, they're doing physical exchanges. They actually need the silver for solar panels and cell phones and computers and you name it. I mean, we have a whole world that is dependent on silver, so it is being used up. And so my question, I guess your second biggest question is, okay, so when does this event happen? When does somebody say, oops, we don't have any silver to deliver? When do you think that's going to happen, or how close do you think we are from that?
Great question. First of all, a little background. I will answer your question. A little background on China. China was actually a net exporter of silver going back over a decade. And then some time ago, a great time ago, like I forget exactly, like 8 years, then China basically said, we are not going to export any silver. And they started to become a net importer of silver. For lots of reasons. A lot of silver gets processed or smelted and refined in China. Additional to that, you have the Shanghai Silver Exchange. And there's an article written by S.R. Rocco, a friend of mine. I speak to him on the phone probably once a month or so, that he published on the 25th of August, which is, very recent times, about how much silver has been depleted off the Shanghai Silver Exchange. And they asked the question, at the rate that it's being depleted, this is physical silver now, I want to be clear, the most important part, the physical market, at this rate, how long will it last? And the answer is, I don't know, and he doesn't know, and actually no one knows. But it is cause of concern, because is that the pinch point? And the answer is, I don't know, but it sure looks like it could be the pinch point. And it may be. What I do know is when I met with the Mining Bureau at the top level when I was in Beijing, they seemed to me to be more interested in the silver market than the gold market. Now, realize I'm biased. I mean, I'm very biased towards silver. I love gold. I advocate gold. I think everyone should own both gold and silver, but they're basically two different precious metals and they have different dynamics. Silver much more on the industrial side, whereas gold primarily just money. Silver has a monetary aspect, but it also has a large industrial component. China knew where they were going to go in the future. I'm talking about silver about a decade ago when I was there, that their industrial base is going to explode, which it has. Of course, they're having trouble recently. I admit that. Nonetheless, their thirst for silver goes unabated, and that there's more and more applications for silver really all the time. You go back a decade, the industrial demand was about 35% of the market. Now the industrial demand is 55% of the market. And we've been expanding the production of silver at about a 3% compounded growth for the last decade. So the whole time that more and more silver has been coming out of the ground for the last 10 years, even with that increased amount of silver, the industrial component has gone from 35% to 55%. So that shows you that the overall long-term trend for our silver's use in industry has continued to go up. And so there's a lot at play, Greg, and coming back to the exact question I already answered about, the point could be the Shanghai exchange, but I want to go further, and that is the market's much tighter than the price would suggest. I mean, the price sitting here, almost
the 18s
$8, it shows that, oh my goodness, you would think at that price there must be, so much silver out there that when you drive down the street, you've got to, drive around those silver bars littering the highway because it's all over the place. But that's anything but the truth. There's a very, it's not a super tight supply. I want to be clear. I've seen it tighter. In fact, when we were at $19 the last time, which was before the 2011 peak, I was in London speaking, and I said from the speaking platform that I'd never seen the silver market as tight as I saw it at that point in time. And there are a lot of fund managers in that audience. I'm not going to give myself credit for anything. What I'm going to do is just give you the facts. I said that on that stage, and from that point when I came home, the market went from basically 19 to 26, paused out, went from 26 to 48. We're going to need some type of event. We're going to need some type of big buyer. We're going to need, Sprott, PSLV, or the Central Fund of Canada, or Zurich Continental Bank, or somebody to come in, or the Shanghai Exchange to run out, someone to go through the Shanghai Silver Exchange and say, I want this amount of silver, and they can't, come up with it in a reasonable amount of time. Something like that's going to really be the catalyst we need to really put a floor in the silver market, I think, at this point. Could be done by the public. It could be done by the silver stackers, but I doubt it. A lot of that silver retail market is kind of silver that trades hands. There's probably people selling today that, maybe bought it years ago at 10 or 15. It's at 18. They've had it. They're mentally just, they're just burnt out. They can't handle it. The stress is beyond them. They still have a profit. It's like, I'm not going to lose. I bought it at 15. It's at 18. I don't like silver anymore. Morgan doesn't know what he's talking about. I'm out. So a lot of that silver goes to perhaps a new investor that's got the guts to step into the market and says, I'm buying silver cheaper than a primary silver producer can mine it for. It costs them $23 an ounce, and I'm buying it for $5 an ounce less than they are. And I don't want to contradict myself here about, you can't buy silver today at 18 plus the retail markup. You can. What I'm saying before is that you couldn't buy it in size. There's a limited supply, a very small amount.
You could buy it in coins and bags and junk maybe, but not, you're talking tonnage.
I'm talking size.
Yeah.
You put a big order in, it's going to move the price up. I guarantee it.
So I had a guest on, Harvey Organ, and I don't expect you to trash him, but a lot of people want some clarity on this, and you are a silver expert. You're a market expert, and he is of the mind that they're going to run out of silver in China, that they're going to initiate their long contracts and take delivery in COMEX, and all of a sudden the price is going to spike up between now and the end of the year. Same for gold, because when they run out of silver, and he thinks it'll be this year. That couple, about less than 3 million ounces of silver, and they were using it at a couple of million ounces a month. And he says that when this happens, it's going to be a seminal event this year, and then they're going to run to COMEX and drain it, and you'll see a price spike. And he said it was going to go way up, like a couple $100 an ounce silver this year. So can you help us with your analysis? Do you think we're going to run out this year? Are we going to get a big price spike this year? What say you about that analysis?
Well, let's address it kind of in different little blocks. First of all, the Shanghai Silver Exchange is, very much depleted. And again, you can go to that article by SRS Rocco and look up Shanghai Silver Exchange and read it. He put it out on the 25th. In fact, I put it on my Twitter feed. So if you just go to @SilverGuru22, you can read it. So that's a potential pinch point. But it's similar to what happened in 2008. I'll digress for a moment. A lot of people say we ran out of silver. Well, what we ran out of was retail silver. So there was absolutely a shortage, but it wasn't a shortage of silver. It was a shortage of retail silver, coins, small bars, 100-ounce bars, that type of thing. Absolutely short. But as far as the silver itself, 999 fine silver, I bought 3 1,000-ounce bars at the $9 level and took delivery of them. So we could run out of silver on the Shanghai Exchange. And that could be, a few days of a lot of silver price movement and a lot of internet blogging and a lot going on. And yet in the background, the real picture is that there's still, more silver available. As far as the COMEX goes, I mean, after Warren Buffett bought 129.7 million ounces of physical silver, the exchange made a rule change. Now, what they said was that no matter who you are, where you are, or what you are, or how much paper money you've got, you're limited to the amount of physical silver you can take off the COMEX. And that's 1,500 contracts, which is 7.5 million ounces. So
that's per individual.
Individual or entity, that's right. You know,
and what happens if China has what happens if China has multiple proxies that have this one has 1,000 contracts, another person has 1,000, another person, and they all come in and converge at the same time. I think that was Harvey Oregon's premise that these proxies will execute their contracts and take delivery in mass.
Right. Love to answer that. That's the first question I asked of the exchange and asked my broker to find out for me, and I've never gotten an answer. So that's vague, and I'm sorry, but I have to be truthful. I don't know. I really believe they'd say, no, 1,500 total. They're going to, basically, if you read the contract, when you trade futures, they can do anything that they want, including make you settle in cash. So first of all, the first thing that they do is they call you up and say, well, you don't really want delivery. It's ugly. It's this, it's that. And they'll try to talk you out of it. If that doesn't work and you do stand for delivery, then, and you're in size, 7.5 million ounces is more than a retail investor is going to buy, they're going to, they'll probably meet that demand on a total basis. But again, they've never really clarified whether it's per entity or total. So your question stands. I don't know.
Wow,
Again,
that's kind of scary. I mean, if you don't know, and let me give you some props here.
Sure.
You know all about silver. I mean, you know how the markets
Studying
work.
it pretty hard.
I know. You know all about it. And when I ask you a question you don't know the answer to, that's not a demerit on you. That to me is that's a little scary because the markets, it's like the wild wild west. I mean, all this naked short selling. Nobody at the CFTC seems to think that's a problem, even though it's illegal. They're absolutely controlling the markets. All the markets are controlled. But that's a scary premise that you don't know what's going to happen if all these proxies try to take their silver contracts in mass.
That's right. I mean, these guys play it, and the rules are written so loosely or so favorable to the paper traders that they just sort of change the rules as they need. And they're not really changing the rules. I want to be very clear. We had a gentleman from the CFTC that spoke to a group here in Spokane way back, Phillips Baker, CEO of Hecla, gathered all kinds of silver people in a room downtown Spokane. I was one of those many. He had the Silver Users Association, the CFTC, the Silver Institute, CEOs from silver companies. It was a pretty high-powered level of silver experts. And, I was the only real super advocate for buying silver and all that. And so the CFTC guy got up and the first thing he said is, I want to make clear that they never changed the rules on the Hunt brothers. All we did was enforce the rules that were already in place. Well, I couldn't go back on the net and find exactly how the rules were written for futures contracts in that day. What I do know is I've asked the question, was the $1,500, excuse me, I'm getting excited, the 1,500 contract limit per, entity or total? And it was, we'll get back to you on that. And they never have. So then I put pressure on my futures broker and said, I want to know, is this total or is this individual? Because it makes a big difference, if Harvey's right and there's, 1,500 entities that want 1,500 ounces and they're all standing for delivery, it's game over. But if it's 1,500 entities that have 1,500 contracts and they say, oh, only one of you get it, and we're only going to allow that for the next 3 months.
Oh, that's still an undelivery, though, my friend.
Cash, the game's still over.
But the game's still over.
Yeah, the game's still over. The game is going to end. I mean, I am as confident today as I've ever been. It's just, it's frustrating. I mean, I'm frustrated, but it is what it is. Have to accept it. Have to accept the reality that, in a way, you almost have to tip your hat to the banking elites and the financial markets as a whole, because they have got this fiction running the whole system. The derivatives run the system. It's only fiction that's running it. And yes, there are physical commodities that move across the oceans every day. I know that. But that's like 0.1% to maybe 1% of what's going on in the futures markets or the derivatives or the over-the-counter markets. So it's a pathetically small amount of physical relative to the amount of bizarre algorithmic and futures trading, over-the-counter derivatives trading, swap deals, lease deals, all of this bizarre man-made fiction that's going to end. And to get away from the silver market for just a moment, I mean, silver is a big deal to me and to the silver world. But the bigger problem is that all exists in the debt markets. And the debt markets is where the problem is really. And when that problem blows up, believe me, there's going to be a run to gold that's going to be unlike anything in the history of mankind. And a subset of the run to gold that's going to be historic in amounts I can't even describe in words. The spillover into silver will be phenomenal as well. Because once it starts down, everyone that understands what's going on, which will be very few as it's occurring, will be running to gold. They'll try to get gold in any form that they can. Of course, a huge spillover will go in the silver market. And all of a sudden, even not only at the retail level, but at the wholesale level or the commercial level or the futures market level, however you want to think of it, the commercial bar level, it's over. Eric Sprott will call up and say, or somebody like him. Let's just say that an ETF type or silver holding company will say, I want to buy $50 million worth of silver. We think about, 50 million or 150 million or 200 million. I mean, this is peanuts. This is rounding error relative to the bond market. And the answer is going to be we don't have it. Or if you're willing to wait 6 months to a year, we can get it. Or that type of answer. When that happens, it's over. And the problem is that it's a synergistic thing. There's so many things that combine at one time that it could happen overnight. I'm not predicting that, but it certainly could. These type of events usually are anomalies that few people see them coming. I mean, myself, Chris Swain, Andy Hoffman, Butler. I mean, there's lots of my contemporaries that have talked about this for years. And with the silver price being so low over the last 3, a lot of people that once believed us or whatever are going to say, these guys can't be right. The paper manipulators are going to keep it under control forever, but it won't. It will be an event probably, again, unlike anything we've seen. I lived through the 1980 market, so I know what it's like to be in this sentiment where everyone's kind of given up. I watched gold go up to 200. We all thought, oh, this is it. And, the price went back down to 100, and a lot of people gave up and threw in the towel. And, of course, I think, one of the administrations gave, William Simon a tip of the hat, like, nice job in the gold market. And, this stuff's been going on for a long time, Greg. Gold is a very political metal. It's one that's been under, price suppression, if you want to call that, or price management is probably a better word. Probably more than any other commodity in the history of mankind.
And you're saying that you're looking beyond you're painting a perfect storm here. On one side, you have tight supplies and strong hands holding gold, and tight supplies of silver, a small, big actual inventories of available deliverable silver in bulk, and you're saying that, but you look beyond the strong hands holding gold and the tight supplies in silver. You're saying, look at the debt market, because once that blows up, people will run to gold, and when they can't get gold, they'll run to silver, and that's what you're saying.
I am. In fact, I got a lot of this research because I've studied a lot and read a lot and looked a lot, and I've been gold, silver bug for so long, and I go back into my 18, 19-year-old time frame and I was reading my betters, John Exter, Harry Schultz. I mean, a lot of these guys. And John Exter's upside down pyramid explains it very well. And, the derivatives market blows up and you go down the pyramid of liquidity. And the step above the run to gold is the U.S. dollar. Because most people that are undereducated about money think that, if you have physical dollars in your mattress, you are in the safest position you could possibly be. Because let's take the physical greenback. if you have all of your savings in physical greenbacks, you don't worry about a bank failure. And that's like the most important step until that doesn't work. And when that doesn't work is when there's faith in the dollar. And when that's lost or is being lost, then where do you go? And the answer is you go to money that's lasted for 5,000 years. So to see the dollar have all this strength and look good and everyone's running to the dollar, that's just the step before you go to the last step, which is to run to gold. So this doesn't shock me. It doesn't surprise me. It's part of the process. Most people don't understand it, but yet I do. I mean, this run to the dollar right now, to me, is a precursor that's absolutely necessary before the next step down the pyramid. And I'm going to have an article out here for the public because it's that important. If you are anxious to read it, go to Trace Meyer's site, runtogold.com. Look at some of his earlier work or type in Exter pyramid, it's EXTER pyramid into Google or a good search engine. Some of my older articles on that topic will come up again. I'm just going to update my article for the public. But this is the big picture, Greg. I mean, I'm way bigger than the silver market. I mean, it's my expertise. I'm not saying I'm an expert in everything. I'm hardly. But I'm, pretty savvy about how the biggest picture narrows down and why precious metals are so important in today's financial system.
And you're saying that the spike in the dollar is the natural order of things. The dollar has to spike. The dollar will spike before gold and silver because that's the safe asset pyramid getting smaller and smaller and smaller. We're down to bonds and then down to the dollar and then down to, physical gold and silver. Is that what you're saying? Explain
Absolutely.
that. So you're saying this a dollar spike to the mid-80s is a natural order of things. You're not worried about it. As a matter of fact, you're feeling comfortable about it.
I am.
Explain that.
Well, it can do it easier with a diagram, which you can't put on your, the interview, but it's an upside down pyramid. The most stable structure on the planet is a pyramid. The most unstable structure would be that stable structure upside down. And that's what John Exter did. He called the whole financial system an upside down pyramid, which is an extremely accurate analogy to the way the system is structured. So you have the most stable asset of all time, gold, which you would think at the top of the pyramid. Well, it's really at the base of the pyramid because the base is the stability. But there's so little gold in the world relative to how many dollars or currencies there are. And then so the next most trusted thing is, physical currency. And the next most trusted is physical currency that's in a bank.
And gold and silver are down there at the bottom of the pyramid. You have gold at the bottom and silver and then dollars.
Right. And then above dollars, you've got other currencies. And then above currencies in his day, really all you had was like euro dollars. And then you had stocks and bonds, and that was about it. Well, in today's world, you've got, these massive amounts of derivatives, which is the base of the pyramid. So you've got all of this paper sloshing around, like you keep emphasizing, that's running the system, but it's all fake, false gambling's paradise. I mean, if the powers that be or the financial system doesn't keep interest rates low, then basically, excuse my language, I don't know if I can say this, but all hell breaks loose. And we don't know when that's going to happen, but it is going to happen. And then you come down to pyramid. I don't want this toxic derivative. Look, we already know what happened in 2008.
But you're saying
that stuff.
You're saying that this pyramid, which you have derivatives, and then you have stocks and bonds, and then you have currencies, and the dollar, and then silver, and then gold down here at the bottom. And you're saying that it's just coming down to we're down to dollars. You're saying this is a natural order of things. If you want a price spike in gold and silver, you have to have a spike in the dollar first. Is that a good summary?
Absolutely, it's a good summary, and thanks. I'm glad the feedback, I'm explaining it correctly. And think about it. If you're sitting on cash and all of a sudden things aren't going good for cash, well, you're as liquid as you can be in today's system. It's a real easy step to go from that to gold. But if you're holding a stock or a bond or something else or a derivative of some type, you've got to sell that and convert it to cash. But if you're already sitting in cash, this is a one-step process to move from that into a precious metal. So no, it's a natural order of things. This is, not my thinking. It's John Exter's. I agree with him. I've studied it. Trace Mayer did a very great job. Go to Run to Gold. You can read about it there. I'm also putting up an article here in the next couple of days that explains it. And it is just the way it is. So the more that the dollar looks good, It's looking good as the runoff takes place at the beauty pageant, which is probably a stupid analogy, but in other words, the contest isn't over. And so even though the second place one might look like it's going to be the winner, now it isn't. It's going to be a run to gold. That's the winner.
And silver, I guess.
And silver. Now let's spill over into silver. And the silver is such a small market relative to the gold market. See, once gold goes ballistic, then it'll have to go into the mainstream media. They can't ignore it. They might say it's a spike, it's a bubble, stay out. They might do all kinds of spin on it, but they'll have to acknowledge it. And it'll be moving so quickly and so high that people will say, I can't afford gold, at 3,000 an ounce, whatever the level is for them. But silver's only at 60 or 75 or whatever it is at the time. And they'll say, thank goodness, I got, second place. I got silver. I can buy silver. I can't buy gold. So you've got a lot of people with, modest means that have something to protect that can't do it with gold. They'll run to silver. So they both basically have similar patterns. I mean, silver is correlated to gold at 85%, regardless of economic conditions during this cycle. People talk about deflation only or inflation only, or it's this or it's that. It's a crisis hedge. When you don't know what's happening in the markets and you fear something that's going to take place is going to come up or it is happening, you don't stop to consider whether it's a deflation or it's an inflation or, it's this, it's that, it's got to be this or I won't do it. No, you're going to go to where you feel safe. And you feel safe when you have something physical in your hand that has no counterparty risk. And there's only two assets in the world that do that, and that's gold and silver. That's it, period. Nothing else.
Okay, final question. I'm going to end this the way we ended the last interview several months ago. Where do you think silver ends up, at least this year? I'm not going to ask you where the low is going to be, but where do you think it ends up this year, gold and silver? Give me some price points.
Yeah, well.
Or is that unpredictable?
First of all, for everyone that's a member and anyone that follows me in the public domain, I have said that I thought we'd see like $26 silver by the end of the year and probably $1,500 gold. That was prior to this last couple of weeks. And, I'm good at forecasting, but I'm not perfect. And I always let the market take precedence over my thinking. And now that we've seen a new low, the low being tested, perhaps getting a new low, that will alter what it does by the end of the year. What I will put my neck out and say is it's going to be higher than wherever we bottom out in the gold and silver market. So conservatively, back into the 20s for silver and, probably in like the high 13s or maybe 14 for gold. But that just presupposes that the system as it is continues and the paper markets continue and the derivatives markets continue and the powers that be are able to manage this price as they see fit with the derivatives. In the event that something takes place, as I just outlined during the bulk of the show, that whole scenario could go away very, very rapidly. And that's why you really want to be, 6 months too early rather than 6 minutes too late. If you ever want to watch what really happens in a panic, watch the movie Rollover. I put it on my website from time to time, and you don't have to watch the whole movie. All you have to watch is a couple of really good clips. But it's a New York Fed banker talking about this run to gold that I keep referring to. And he's talking to Chris Christopherson, the actor in the movie, and talks about that capital has a mind of its own. It flows where it needs to flow, and it can't be controlled. But us elite bankers really can control it and make sure it flows properly. Because if it flows where it wants to on its own, it could get out of control. And so don't rock the boat, Chris. Let us elite bankers take it, make sure the system is stable and all that. Well, what happens in this fictional movie is that the market gets wind of what's going on because the Arabs get spooked and they decide to sell all of their U.S. assets. And when that happens, then all hell breaks loose. It's an interesting thought experiment. I'm not predicting that. What it does show is the ability of human behavior that the Mises Institute states cannot be predicted 100% of the time. You can do algorithms that'll show you what human behavior, maybe 98% of the time. I want to argue that, but you can't predict it all the time. That's what happened with long-term capital management, the $1 trillion bet that went bad. Their program was so sophisticated and worked so well for years that everyone kept adding and adding and adding money. Well, they had a bad position, kept adding and adding and adding because the math said it can't go on forever or this won't happen. Well, it did happen. The ruble broke. And when the Russian ruble broke, it blew up the whole system. And that was another close call where Green Expand and company came to the rescue and said, oh, it's only funny money anyway, and we won't do this for the public, but we'll certainly do it for our banking buddies or our hedge fund buddies. Here's all the money you need. Let's just look the other way. So that can't go on forever, ever. Anyone that has any inkling of how the real world works knows you can't paper this thing over forever. Something's got to give, and Greg, it may be a lot closer than even I think.
Of course, you could always just insert for Arabs. You could put the Chinese and Russians, or just the
You
Chinese.
certainly could. Yeah. Thanks for inserting that because things have changed dramatically since 1980.
Yeah.
But yes, and go back to Harvey Oregon. I mean, some entities, especially that's the hardest thing is that they might stiff a hedge fund, they might stiff a small trader like me or something like that. But if you stiff China for gold. Or silver, or both. You got a problem. And, that's the problem they're facing.
David Morgan, silver-investor.com. David Morgan, thank you for joining us today on USAWatchdog.com.
My pleasure. Thank you, Greg.